Hello, everybody. This is Dr. Richard Smith, and we are continuing our 80th anniversary celebration of the Foundation for the Study of Cycles with an incredible week of science seminars and financial seminars by some of the world's absolute leading authorities in the markets. And today we have another home run for you, I guarantee it. We are with Larry McMillan of The Option Strategist. And Larry has been in business for over 35 years. He's got the best-selling book on options, Options as a Strategic Investment, sold over 300,000 copies. He has run the equity arbitrage department for major institutions. He's been a prop trader. Larry is the real deal. He manages people's money as well as has a very popular suite of newsletters and publications under his Option Strategist brand. So Larry, welcome.
Thanks a lot, Richard.
Well, we're excited to have you. And I think this is another talk this week that while it's not explicitly about cycles in the strictly periodic sense, what we're really talking about is cycles of sentiment, and especially sentiment extremes, and how you can detect those through the options market, and also how you can make money on those cycles of sentiment with using options as a tool. So, do I have that right?
Yes, sound very good summary.
Excellent. All right, well, I'm going to turn it over to you. I'm going to turn off my camera. I'm sure I'll butt in every once in a while. I will be fielding questions from the audience too. Are you okay with questions kind of mid, as they come, or do you want to kind of hold it to the end?
I usually hold it till the end, but if you think it's, I could do either one.
Okay. All right. Well, if something really compelling comes up, I'll jump in. But for the most part, I'll leave it to you and take it away.
Okay, thanks. So we're going to talk about various option indicators that we follow. As Richard said, they're not periodic cycles, but they are cycles in sentiment and volatility and other things like that. So just a quick amount of background. I started this firm like 30 years ago. We started as a derivatives research firm. But we had some very excellent calls in the 2008 bear market. So at that time, kind of at the prompting of some of our clients, we moved into money management. So we're both a CTA and an RIA managing individual option accounts, SMA accounts. And we also do a certain amount of education, like mentoring or this webinar. Our accounts are up. Our managed accounts are up in the year 2000, and a lot of people could say that by the end of the year, but actually, our accounts were up in March, so not everybody can say that. Also, our newsletters had an excellent track record last year, and hopefully off to a good start again this year. I am going to be talking about a discount in those newsletters later, and we're also be sending you the PDF of this webinar. You can get it yourself by going to that website, optionstrategist.com/cycles. So before I start, this cartoon came to me the other day, and it's just like, everybody laughs when they see this, but it's, Peter Pan taking one of the boys and saying they're going to go to Neverland. And he says, "Oh, we're going to Wall Street," because that's just sort of the way it feels right now. The indicators are bullish, and a lot of them are overbought, but so far we haven't seen any really cracks in the armor. So this is the broad category of things we're going to look at. Overlying all of this, or underlying perhaps, I have an important rule. It's two parts to it. The first part is oversold does not mean buy. So when the market starts down like it did last February, March, it was probably oversold at the end of the first week, but the decline lasted for 4 really nasty weeks. And so just buying on the first oversold condition would have been a disastrous approach. So we wait for confirmed signals, and much more appropriate to today's market, overbought does not mean sell either. So I see, sometimes you see people say, oh, the market's overbought, so you need to sell it here. Well, the market probably got overbought about last June, and it's gone a long ways higher since then. So, we again wait for confirmed signals. So here's the 2-year chart of the S&P 500, and you can see that the two really extremely oversold conditions. The first was that December 24th, 2018, right before Christmas. That kind of ruined Christmas for a lot of traders that year. And then, of course, last March. Right? We don't buy on that way down. We wait for it to rebound. So we're probably buying, a week or two later, but there's still plenty of upside left at that time. Now, as far as overbought, last year in January and February, I should probably also point to there, January and February of 2020, the market was very overbought, and of course, it rolled over into the nasty bear market. Then got very overbought again in September, and now we're approaching the same situation now. But since we've just made a new all-time high yesterday, and the chart is, we haven't even closed below the 20-day moving average since here. That's early November. So this chart is very bullish, and whether you call it a cycle or not, the trend is up. And as long as the trend of the S&P chart is obvious, that's your main indicator that you really need to pay attention to. You can work in sell signals around this if you want, but we're looking at these various support areas, and this one being kind of the most important. If we should break that level, then we might have to change and figure we're going back into a bearish period. Along with that, we have an option-oriented way of looking at the Bollinger Bands. And Bollinger Bands in and of themselves are somewhat cycle-oriented. In other words, the market goes from way overbought going through the upper bands to way oversold going through the lower bands. So when John Bollinger invented Bollinger Bands, he defined volatility as realized volatility as the standard deviation of daily closing prices. But the math guys, and we have to pay a lot of attention to what Black-Scholes says and does, because that is our model that we use for our option pricing, and that has specific volatility definition built into it too. And that one is the standard deviation of daily percentage price changes. It's a slightly different calculation, so we call these modified Bollinger Bands. And when they go outside the plus and minus 4 standard deviation band and they come back inside the 3 standard deviation, that's our signal. So there's been some great trades in this over the years, but there were also a number of false signals. So we put an overlay on this, which we call McMillan volatility bands, and that is we require some confirmation. So here's the chart going back 1 year. And the bands are drawn on the chart here. So you can see like this band right there, that's the plus 4 standard deviation band. And then the one just inside that is plus 3 standard deviations. So you can see that, for example, here we went outside and then inside, that was a sell signal. Previously, there had been a sell signal that went inside and it came back outside again. So that blue letter means it was a losing signal. Red letter means it was a winning signal. Obviously, this, even though the market went a little bit higher in February of last year, it was still in force when that sell signal was still in force when the market collapsed because we had not gone back outside the plus 4 sigma.
So Larry, 4 standard deviations, what is that, like 99% of the time it's not supposed to get out of there?
Well, right. I mean, this, when I set this up a number of years ago, I believe John Bollinger on Bollinger Band uses 2 and 3 standard deviations, but stocks move a lot more than that. So stocks really move in a fat tail distribution, and this way of handling standard deviations is strictly the normal sense, log normal sense. So it's easier because of real life. It will move outside of those bands occasionally.
Yeah.
So we had a good sell signal here in September. Now we just got one, January 4th, and obviously not performing too well right now. We have not gone outside the plus 4 standard deviation band, which is right there. But if we do, it will stop that out. It will just set up another signal, perhaps. But right now, this is similar to last year where we got the premature signal I marked it as a red letter, but from there over till about here, it didn't look like it was going to be a good signal, and then it kicked in. These McMillan volatility bands are available on the charting service at tradingview.com through a subscription. And when you get that, it looks like this. So when a sell signal appears and you've paid for this service, you get a red arrow on the chart, and when a buy signal appears here. So you can see it eliminated some of the false signals that were along the way. And this is this is not a current chart, it's just up through like October. But what turns out it's a useful approach to many stocks, and even on a 5-minute chart if you're a day trader, that sort of thing. Anyways, let's move into an option indicator that is more cyclical, although moving in and out of plus or minus 4 standard deviation bands is somewhat cyclical, not periodic. So put call ratios were invented as an indicator by Marty Zweig back in the 1950s. In those days, he would get the option volume on Sundays out of the ads being run in Barron's by the put and call dealers. And just a few hundred options would be traded all week long by each of the dealers. But when he added it up, he noticed that if there was a lot of put trading, the market went up. And if there was a lot of call trading, the market tended to go down. So it's a contrary indicator. For today's purposes, for our purposes, I mean, not today specifically, but modern purposes, we use the equity-only put-call ratio, and that's, in other words, all stock options that trade on all the exchanges, millions of them. That's what we use as our indicator for the broad stock market, and I'll show you why. But Marty's theory, as I said, was too much put buying is bullish for the market, too much call buying is bearish. We'll try to define what too much is, and this is somewhat where the cycles come in. So let's just, as an example, suppose we look at IBM at the end of the day, and we sum up the volume of all the puts traded in IBM, and then separately sum up the volume of all the calls traded, divide the two. That's the standard put-call ratio. Now, since puts are in the numerator of that fraction, heavy put buying will make the ratio go higher. But when are you likely to have heavy put buying? Well, that's when the stock is going lower. So the ratio and the stock price move opposite to each other. Similarly with calls are in the denominator of the fraction. So heavy call buying will make the ratio go lower. But when are you likely to have heavy call buying? Well, that's when the stock is going up. So again, they move inversely to each other. We keep 21-day moving average just in case Fibonacci works. Not really sure about that, but anyway, this is what the ideal put-call ratio chart should look like when plotted along with the stock price. Now, on our website, in a fairly inexpensive area, we put about 650 put-call ratio charts along with the stock price every day. But let's take a look at this one. Suppose the stock is declining here, going along like this. And since the stock is going down, traders are buying puts, and they're right during the trend. But then, the trend will eventually peaks out. So you get a local maximum on the put-call ratio chart. That's a buy signal for the stock. Now the stock starts to go up. Let's move over to the left side here. So the stock is going up, and people are buying calls. That forces the ratio lower. Eventually, the ratio bottoms out with a local minimum, and a local minimum is a sell signal for the stock. So that's the ideal world. This chart is not current, but on the top is the S&P 500 index, and on the bottom is the equity-only put-call ratio that I talked about. And you can see the inverse symmetry that exists most of the time, and that is why we use the equity-only put-call ratio to predict the stock market. So here's the current chart of the equity-only ratio. And normally you would see the market cycling back and forth between a very bullish extreme like we had last January and formed a local minimum on the chart. And that was a sell signal. Again, that was premature. The market moved higher in February, but you can see the sell signal. A local maximum never formed. It just kind of went sideways and then went up here. And now you had extreme bearishness. In fact, the highest in our database, which goes back to 1993. And finally, you got the local maximum on the put-call ratio chart, which was a buy signal for the stock. Now we use a computer program that's similar a little bit to a chess playing program, chess tree. It looks forward about 10 days, and it can tell you or give you a good hint anyways as to whether this is going to be a lasting rollover to a buy signal there, or if it thinks there's a probability that it just goes higher. So we actually got that buy signal about 1 day after the market low, maybe March 24th, because of that computer program. And then even on this little blip upwards here, the analysis program said no, still stay long the market. And then the ratio went all the way down, and sentiment went from, again, extreme pessimism to pretty heavy optimism last June. And since then, if you can see where this ratio was here in January a year ago, which was an extremely optimistic situation, you can see we've been, it wasn't a very good attempt to draw a straight line. We've been below that all the last 6 months. So we are in a situation where there's extremely heavy call buying. It's making this indicator very overbought, but it's just oscillating down here at these low levels. So we have not really acted on any of these signals except these two right here. And even they were rather short-lived. Now we move down in late December here when another heavy round of call buying took place, and we formed the local minimum here, which is the lowest this ratio had been since in 20 years. And that's very unusual because over time, the put-call ratios tend to rise slightly as more and more institutions understand the value of buying puts to protect your portfolio. So usually the puts in the put-call ratio rise over time. The put volume rises over time, and the put-call ratio would go higher. For it to be the same place it was 20 years ago is really amazing. But right now, I've marked this in blue because I don't really consider that to be a strong signal. I would not call this a sell signal until either A, the ratio started to rise sharply, or B, I guess I would say S&P broke through support. That 3630 support I was telling you about is about right there.
So
Neither
Barry,
of those
are
things.
you just looking at the slope of those, bottoms and tops there to trigger a sell or a buy?
Right, and also that computer program that has that 10-day look forward will tell you if the percentages of that local in this case, local minimum, holding up are good or bad. They're not that good right now. But what's happened is sort of reversion to the mean. I'm going to show you some specific daily figures in a minute. But
well, to me, this chart is the great mystery of what's going on in this market right now. With all of the novice traders, the Robin Hoodies, as I like to call them, buying call options, and by all accounts, winning.
Yeah. Yeah, if
beating
you're long,
the insiders. Is that what you think is going on? I mean, how long can that last?
Well, it's
The markets
already
can
lasted a
remain
lot
irrational longer than we can remain solvent, right?
Exactly. So I mean, at this point, I'd have to say, I'm not really that interested in taking a sell signal here until S&P breaks support. Just because of what you just said, that these guys are still in there. That are buying, and I don't think they were existent a year ago too much, and so this was much more of a true optimistic extreme than where we are right now, probably.
Something structurally has changed in the markets over the past 6 months.
Yeah, just look at Twitter or TikTok. You'll find all these testimonials. Anyway, it wasn't just this ratio that's low in December. The total put-call ratio we look at is index options plus stock options. That's the lowest it's been in 20 years. The CBOE publishes their own equity-only put-call ratio. The data I was just showing you is across all option exchanges in the U.S. I believe there's 8 of them now, maybe 9. But the CBOE, similar data, the lowest ratio since 2001. And Richard, you mentioned, Robinhood, but there's also been a heavy buying by SoftBank, which is a Japanese firm that does a lot of different things, but they started a call buying operation and funded it with a lot of money, and that's been extremely speculative as well, and caused a sort of explosion in terms of volatility last September. I'll come to that chart later. But as computers have come along, we can measure put-call ratio or sentiment in another way, and that's by dollar volume. So the way we do it is at the end of the day, for each option, let's say each option at IBM, I take the option's closing price and multiply it by the volume of the option that traded that day, and that comes up with the dollar volume for that option. Now, you could do it on a trade-by-trade basis, tick by tick. That's an expensive data set, and we tried it for a while. It wasn't really giving us any better results than just doing it this way. So we make that calculation for every option, then we sum them up for all the puts, and we sum them up for all the calls, divide the two. And now what we've got is the weighted or dollar weighted put call ratio, which is measuring the dollars being spent on bearish opinion versus the dollars being spent on bullish opinion. So here's the current chart of that. And you can see here, this ratio had a similar pattern, and the buy in March. But what is happening here, the 200 means that $200 were being spent on puts for every $100 being spent on calls. And in maybe in index options, that's not too unusual, but in stock options, that's crazy. That's the highest since 2008. And the 2008 peak was the highest ever. But you can see that it also had good sell signal, but slightly premature last January. And again, a sell signal in September. This isn't quite as noisy with the signals back and forth, but still is. And then we came down here in December almost to this level here. So that level was the lowest it had been in 16 years. And the reason this didn't go to a new low is that probably, again, the Robinhood traders, they're buying more out of the money options and not spending as many dollars. And so it didn't force the dollar weighted ratio down to 20-year lows like it did with the standard ratio. But again, this is just moving sideways, really. Yes, I realize it's going up a little bit, but it's not the increase that I'd like to see. So again, I'm not calling this an actionable sell signal. Now, this year we've had, or last year, actually 2020, we had that good sell signal in January, the buy signal in March, and the sell signal in September. So this is an indicator that's worked really well for us in the past, and I'm waiting for it to reach that acceleration stage, but it hasn't. So right now, I'm just saying this is bullish or maybe neutral until the ratios begin to rise again. Now, this is a chart that shows this is using CBOE equity only put call ratio. And the blue distribution is how we have 20 years of history. This is how it normally be distributed. So a ratio of 65 on any given day means, for example, 65 puts traded for every 100 calls. So you can see that typically, in a normal year, you've got about 12% of the time your ratio is 55, and then 18% of the time your ratio was 60. And you can see the blue kind of forming, a nice pattern, and so your average daily ratios would be in that neighborhood. So that's what the 20-year thing looks like. The red line is what happened last year, 2020, and you can see that there was this, because of this huge option call buying, the daily ratios were much lower than they normally would be. So they're the red line. So 7% of the time we had a daily ratio of 40 or less, whereas normally that would happen about 1% of the time. And ironically, it even has extra on the high end because of that March, sell-off. Wow. Now, if we look at the same data, but we just take last year's numbers in terms of the average year. If we have 20 years of data, on average, 5% of the time it should be, each of these numbers. But each 1 year should equal have 5% of the readings at each of these numbers. But that's not really true at all for last year at all. That's this line. So 49% of all of the readings below 40 in the last 20 years occurred in 2020. And
I see.
46% of all the readings between 40 and 45 over a 20-year period occurred last year. Hardly anything happened here in the middle, and then we had a little blip up on the other end. So we took this data and took a little closer look at it. On the right here,
there's some fat tails.
Yeah, by year, how many times the put-call ratio, the CBOE equity put-call ratio was below 45? Now, you know there's about 250 trading days in a year. So in 2001, there were 18. That's quite a few. In 2003, there were 16. We had several years there where there were 1 or 0. Many years where it was 1 or 0. And then last year, 67.
Wow.
So something has changed, but to say it's different this time is always dangerous. So let's look at these ratios here. So in 2001, we had 18 readings, and that was the highest ever before last year. Of course, the bull market started. Maybe it had already started in 2001. There's a debate about that, but it certainly was cranking in 2002. This high reading in 2003 didn't necessarily cause a bear market. It sort of did in Russell 2000 stocks, but it's flat in the S&P. 2010 led to a bearish market in 2011. I mean, that's what happened in the fall of 2011. Some people were calling a bear market, and now this year. So I'm just saying.
So in other words, when you had these extreme levels of call buying, it portended bearish markets in the next year. Right. Bearish to flat, and 2021 was unprecedented, off the charts, quadruple the average for over frothy call buying.
Right. But it's crazy. We've already had 7 days this year. So it's continuing. Anyway, so I don't like when people say it's different this time. It's really never different this time. And this will end poorly, as all of these have in the past. It's just a matter of when. So that's why I don't want to fool around with it down in an overbought state. But when it starts leaving the overbought area and the ratios start to rise, that's when the market will break. I want to show you. I was just going to just throw in here briefly. What do we trade when we trade these things? So if I'm predicting the underlying, in this case the S&P 500, I want to buy an option that's going to move with the underlying. So the delta of say a call option ranges between 0 and 1. So 0 meaning you bought a very deeply out of the money call option and it hardly moves at all, and 1 meaning you bought a deeply in the money call option and it moves right along with the stock. So the higher the delta, the more the option behaves like the underlying. So many traders, especially novices, attempt to buy a call with a low delta, figuring it's going to be a lottery ticket, and in fact, it just loses money. So I don't want to be right on the underlying and wrong on the option. So we tend to buy in the money options for a short-term trade, say like the volatility band trade. I'll look for an option at 70 or higher. For a put-call ratio trade, which could last for months, there I'll buy more of an at-the-money option. But even an at-the-money call has a delta of 0.55. So I'm looking, for my call to move responsively with the underlying. If what I'm really trying to do is predict the underlying and just use options to trade it with to lower my total dollar risk. I always get this question: when do you spread? If you watch these option guys on TV, it seems like they're always spreading. In reality, that's not the right approach. When you put a bull spread on a call spread in a bullish situation,
can you just explain for the audience what a bull spread is?
Right. Okay. So let's just say that SPY right now is I don't know where it closed today. Let's just get it right. 384. So if you're bullish on the market, you might just buy a March 384 call. That's a simple way, but those are kind of expensive. So you might also sell a March 400 call against it. So that's a bull spread. And that it's wonderful until the stock gets up to 400. Now you've cut off any profit potential beyond that. Obviously, the closer you put those two strikes together, the more their chance there is you'll cut off your profit potential.
Right.
So what if the really easy way to do this is to look at the implied volatility of the options. So we have a lot of implied volatility history on our website as well. We put up about 2,000 implied volatility charts every day. And if the options are average cost or cheap, you do not want to spread. If the options are expensive, which they sort of are now, then you can spread. But even that doesn't guarantee that that's the optimal strategy. For example, last March, when the market took off on the downside, you might have put on some bearish spreads. You thought that was a good idea. And in fact, that wasn't a good idea at all. The thing got crushed and went right through your spread. So if you do spread, you want to try to spread the strikes out apart. So right now, if we're doing a SPY spread, we're doing about 15 points apart, or in that last example, they're 16 points apart on this calls. If you do with the puts are more expensive. You can widen that out to like 30 points. And then another thing you can do to stop from cutting off your profit potential is if it rises up to the short strike 400 in that last example, then you sell the spread you bought before. It's a profit at that point. You sell that and you buy a new spread with higher strikes. Now, proponents of using the spreads always say, well, you're risking less money. You're not. You're risking 100% if you buy a call spread or the call. It's dollars, yes, different dollars, but 100% in each case. So if you're really worried about the dollars, it's just buy fewer calls and you wouldn't have spreads.
Yeah.
Anyways, I want to show you, before we leave the put call area, a couple of individual charts. Now, we do look at these on an individual chart basis too. And here we only take the signals that are coming from extreme local maximums or local minimum. So we want to make sure there's also some history of positive signals, positive results in the signals. And we once we put the trade on, I'm at that point no longer looking at the stock chart. I'm looking at the put call ratio chart. So we've implemented this change to our strategy and the option strategy, this newsletter, about 6 years ago, and it really improved the results. So we've had a lot of good trades. I'll just show you a couple of current ones.
Can you go back to that for just a second, Larry? That seemed important, and I didn't get it all. So
okay.
Well, go over that one more time.
I'll explain the points as we go through the chart too. But rather than taking every single put call ratio trade that comes up with every wiggle, we're only going to do the extreme high ones or extreme low ones.
Okay.
And then I also would make sure that the last time it was at that extreme, if we can see it, that it worked. And then also, once we're in the trade, I'm going to stay in the trade as long as the put call ratio is on that same track. So here's a chart. This is Activision Blizzard. You can see the put call ratio here recently came down and made a local minimum. So that's a sell signal. By the way, you can see over here it's less than 20. So that means, let's say it's 16. That means 16 puts are trading for every 100 calls. That's not very many. So usually a signal from that ratio, that low level, will work, although this one did not. So the blue letter means it didn't work. But when it gets below 20, I like to take those signals. In this particular case, there's a little support level at 88 on the chart, if you look. So we are not going to actually buy the puts until it breaks 88. It hasn't done that yet. And it may not do that, in which case I won't have this trade. But we'll combine a support level sometimes with the put call ratio. Now here's one that we didn't bother with looking for a support level. We just took this kind of double sell signal here and we bought puts, and it was around in this area. You can see now that the stock has started to turn up on Seagate, but the put call ratio has not rolled back over and started to head down. So the put call ratio here is still aiming higher.
Okay.
So this is where I say we stay with the trade chart of the put call ratio, and not the stock. Now, I may give it's not always optimal, but these are the ways that have worked in the past.
Yeah.
Here's another one, AIG, that we also have a support level there. We were waiting to see if it broke that, and it hasn't. In fact, it's gone higher, so it doesn't look like we're really going to be buying puts there. And we can do it with commodities too. This is cotton. On the top is the continuous chart of cotton futures. And the put call ratio is created using the cotton options that trade on the COMEX. The futures charts tend to really, really run for a long time before the cycle changes from bullish or from optimistic to pessimistic. So here we're too optimistic, and that was a pretty good sell signal. Then we got over here, too pessimistic. Got the local maximum buy. So it stayed on that thing now forever. I really thought this was going to be a sell signal there, but once it breaks back to a new low, that cancels out anything you might have acted on that. So now we're down, for cotton, really low levels. This is the weighted ratio, by the way. So here we're down below 50, meaning $50 being spent on puts for every $100 being spent on calls. But we don't have a signal there yet. And right now the grains are, similar things. Put call ratios are plunging, they're going higher. But as long as, until they actually roll over, we don't have a sell signal there. All right, so let's move on to another area that we look at with breadth, and we have created, again, here some option-oriented version of this. But simply with breadth, you can keep a running total. You can just take every day the advances minus the declines and keep a running total of that. Or you can do an oscillator, and we do both. The oscillator is calculated this way. Today's oscillator value is 90% of yesterday's oscillator value, plus 10% of today's difference between advances and declines. Now, we use two different data sets, one being New York Stock Exchange. That's everybody's common area to find advances and declines. But, not everything on New York Stock Exchange is a stock. You got preferred stocks, you have interest rate related ETFs and other things. So we created also a stocks only data set. And for us, that means all stocks that have listed options on them. Now, there's almost 6,000 of those now. So that's getting to be a pretty big data set. We calculate these things on both. If you want to calculate this at home, you need the starting point. You need to know what yesterday's value is to get started. So for the New York Stock Exchange, I can give that to you. Just shoot me an email or something. For the stocks only, though, you won't be able to calculate this daily at home because it's not published anywhere except in our newsletters and things. So here is the stocks only oscillator going back about 8 years, so to 2013. And, most of the time in the last 8 years, the market's been going up. So we define oversold as when the oscillator gets below minus 400. And you can see it hasn't been oversold all that much. But it did get very oversold here. That was that December 24, 2018. And then this is the past March, just a little bit lower than it was then. It kind of illustrates how bad things were there back in 2018. But again, oversold does not mean buy. So we don't buy until it stops being oversold. It comes out of this condition. So here, I believe that was about January 8th of 2019. Plenty of upside left there. And then this year, that was about, I believe, April 4th or something, roughly. And again, plenty of upside left after that. Now, when it gets overbought, which is up here in the red area, that's fine. And while it's overbought, the market continued to go higher. This early 2019 area saw a very massive amount of both, volume and breadth, and it was that big red blob there, and it was extremely overbought. Eventually, it came out of there, but it was a very short-lived sell signal, but right there went right back into a buy. This year, as we came out of the massive oversold condition, we got a pretty big overbought area, but not that same, consistent, solid picture we had in early 2019. However, we did set a new overbought record in June. Anyway, currently we were overbought again in the fall, and we attempted to have a sell signal late last year, didn't take effect, and now we're up here. We're back in overbought territory.
And as
Today,
you said earlier, you're not buying just because it's extremely overbought. I mean, you're
yeah,
not selling just
right.
because it's extremely overbought.
Now, today we had a negative breadth, and that's not on this chart. The chart through last night. So not enough to knock that back down below plus 200. But if we had another day tomorrow of equally negative breadth, say maybe 1,000 issues negative, more declines than advances, then we would get a sell signal there. This is a very short-term indicator, and it can whipsaw you. So while it had some good signals last fall, also, you always have to be aware of the fact that these very short-term indicators could be whipsaw. So we use caution. I mean, we trade this, say, small. Now, I said you can also keep a cumulative total of breadth. And recently, cumulative total all made new all-time highs. New York Stock Exchange data, stocks only data, all making new all-time highs in terms of cumulative breadth. We also keep track of cumulative volume breadth. In other words, volume on advancing issues minus volume on declining issues. That has also been making new all-time highs. In fact, for 10 of the past 11 trading days through yesterday, it had made a new all-time high, which is really amazing. And it's so strong that it's, even though it's overbought, I saw one guy recently was quoted, it's so overbought it's bullish. It's just like, what do you, 10 of 11 days, amazing. Anyway, these are a situation right now where I know some people try to say this is positive for the market, but it's not really. There have been several times in bear markets have started when S&P was near an all-time high, and these breadth areas were at an all-time high. In fact, last February, I believe 23rd, market made a new all-time high, and by February 28th, you had gapped down massively, and you're off to the races in the bear market. So these are only useful now at this point if they become a negative divergence. If S&P continues on to make new highs, and these don't. But that's not the case right now. So they're interesting, but they're not predictive at these levels. So let's take a look at volatility now. We do a number of things with volatility. One of the things that's very important is the trend of VIX, which is the Volatility Index created by the CBOE back in 1993. VIX should be trending opposite to the stock market. Another thing that we look at on the VIX chart are spike peaks. These are, I guess you could call them mini cycles. They happen all over the place. So what it is people get very bearish for a very short period of time. VIX spikes up, and then everybody says, well, wait a minute, that's not so bad. It goes back down again. That's a buy signal. This is not the case right now. I would not consider VIX overbought here, but when it was below 14, 15, that was overbought. And again, by our rule, that's fine. Market can continue to go up while VIX is low. I mean, sometimes you'll see people say, oh, VIX is too low, you have to sell the market. But really, you don't want to sell it until VIX begins to rise. So this is the current chart. And to address that last point, let's start on the left-hand side of the chart here, where, where's my point? Here it is. So VIX was trading in late 2019 and early 2020, down here below 15. And it tried to rise a little bit, came back down. But then right here, you had a major turning point. So this is your 200-day. This is your 20-day. On February 21st, which was a couple of days before the market actually broke, VIX rose above its 200-day, and the 20-day rose above the 200-day. So that's a major sell signal, a major trend change, moving out of an overbought condition into a full-blown sell signal. It stayed there for a long time because VIX went so high, and the whole thing didn't really reverse back the other way until late July. But we've gone up a long way since late July. So right now, here's your 200-day, here's your 20-day, here's VIX. The 20-day and VIX are both below the 200-day, which is declining. That's relatively bullish for stocks. Nothing is aiming to the upside yet. So that's fine. Now, these Bs all over the place here are those VIX spike peak buy signals. We have a very specific trading system built around them, which we don't make a big secret of. It's available in the newsletters and things. But we most recently had a spike peak buy signal on January 5th. And that's still in effect. They last about a month. This was one that, you had mentioned before, where Robinhood, and in this case more the SoftBank, they were buying options so heavily, they were forcing market makers to hedge themselves and further buy out of the money options, raising volatilities and making VIX go higher. And you got this spike peak right there around September 4th, which was not at all a market buy point. It was actually a market sell point. So that's why it's in blue. But what happened there was a function of these call buyers going kind of crazy at the end of August into early September. And the hedgers was actually made the volatility go up. You can see the various ones over time. Of course, the big one up here. When you get one of these signals, we typically buy SPY calls. But you could also buy VIX puts. I mean, depending where you are in the chart. Up here, that was a good time to buy VIX puts. You're way down here, you get a buy sale. You wouldn't want to buy VIX puts down there. Not going to go down that much, but SPY could go up a lot. So, right now in this latest excursion, we bought call spreads because VIX is somewhat expensive. And that's actually a problem in its own right. Realized volatility, as you're going to see in a minute, is hovering down around 11. And yet VIX is here at 21. That's a big difference.
I don't know what realized volatility is.
Well, that's where you take the standard deviation. I'm going to show a chart in American.
Okay.
But so this is a bit of a...
Options are expensive right now.
Yeah, and VIX is elevated, which means that some people are a little nervous about what's coming down the road, and they're probably the bigger traders because they're keeping... This is based on SPX options and heavily influenced by SPX put options, and the small people don't trade those. They're too expensive. So this is more of like, I don't know, you call it smart money. What's smart these days? But... that's the fact that VIX is high is a little bit troublesome. But in any case, just to summarize, we've got that buy signal on January 5th. The trend looks pretty good because these are below 200-day moving average is declining. So everything here is pretty good except for the elevated VIX. That's a little bit of a worry. So you can't trade VIX. It's a very complicated calculation. But you can trade VIX futures and options, which are based on VIX, and they settle at the end of their life to a VIX price that's pretty close to a price that's pretty close to VIX, but it's not exactly that. But we can gain some insight from how these futures are behaving with respect to VIX. So most of the time, VIX is, say, here, whatever level. And then the 1 month futures are here, and the 2 month futures are there, 3 months. So they're all trading higher than VIX, and the term structure slopes upwards. So when that's the case, which is probably the case 90% of the time, that's bullish for stocks. However, when the opposite happens, and this happened, in the last March, so VIX at one point, let's say, was 70, and the front month futures were like 53. And then lower and lower and lower. This downward sloping term structure and a high VIX, that's bearish for stocks. So where are we right now? Well, here's the current futures construct as of last night. And the front month is now brand new. February front month, the January's just expired. February futures on VIX. So they're trading at 24.77 last night, and they are based on S&P options that expire in March. It's just the way they're constructed. So just to understand that. So right now, they're trading at 24.77, and last night VIX was 21.58. You subtract the two, and that's $3.19. So they're trading at a pretty high premium to VIX. That's high for
So the curve is
for the
sloping up.
yeah, and then then the curve slopes up, at least in the front end, right here, that goes up, and then after that, it's pretty flat. You can see, hey, these are almost all the same number.
Right.
So it slopes up a little bit and then flattens off. So it's not perfectly bullish, and but it's bullish enough, and it's good as long as February trades lower than March. If that relationship reverses and February trades above March, that is usually an immediate and extreme warning sign. Some of the biggest declines we've had in the last 20 years have been, these started trading in 2004, have been signaled by that inversion in the term structure. If you don't have the price of VIX futures,
what it's telling us is that there's sort of a what is that telling us? So when the nearest month futures contract becomes urgent, right?
Right. So
that's
the term structure,
a lot of people are trying to cover.
Well, normally the term structure in a bullish market slopes like this, and in a bearish market slopes like this. But to get from here to there, some point along the way, that front month has to jump above the second month.
I'm just trying to think, what does that mean? What's going on psychologically that's causing people to do something abnormal like that?
Well, typically it's this. Let's suppose you want to buy protection for your portfolio.
Yeah.
And you look at the prices of all the available puts. What's the cheapest one dollar-wise? It's the front. The nearest term. So that's what people start to buy. Right. They start to buy the front month puts for protection. And again, these are institutional traders, somewhat smart money, and they'll force the price, the implied volatility of those front month options up above the implied volatility of the other months. That indicates they're really aggressively buying protection, and they really need it.
They know something's coming.
Right. Or it's already started to come.
Right. Okay. It already started to come, and it's not going to end soon.
Yeah. Right. Exactly.
Got it.
So this is if you don't have access to the VIX futures prices, although you can get them on most platforms delayed. The CBOE publishes 5 different volatility indices. We know VIX, that's a 30-day index, but there's also a 9-day, a 3-month, a 6-month, and a 1 year. And right now, this is where they are today. And you can see, again, the term structure slopes upwards. But if it starts to invert, for example, one of the big ones we look at, if VIX goes above VIX 3M, which is the 9-month, that's a bearish sign. And you should take action until it reverses. Now, when it does reverse, that's an actual another short-term buy signal. But when it gets to this state, it can stay there for a while, and so you don't want to be long the market when the 30-day volatility is higher than the 3-month volatility.
All right.
So just summarize the same thing. So the term structures are still sloping upwards. The futures are at a premium. That's fairly bullish. Now, it would be, of course, the major sell signal if the 2 front months invert, and we have been mentioning that in our newsletters. And the first day that happens, I'm going to be moving into some long puts. Not a monster amount, especially if S&P is still above support, SPX. But I am going to act on that signal. Now, you mentioned realized volatility. So realized volatility is...
One question that we had was, at one point earlier in the presentation, you said there was a sell signal on January 4th, and then you just said that this one gave a buy signal on January 5th.
You are correct. So how are we treating this? It's always a good, how do you handle this? So the major trend is up. We saw that from the S&P chart. And so we are long.
And that continues even, the VIX buy spike was the signal on January 5th. There was this kind of spike in VIX.
Right.
So that we added to that's bullish.
Yeah, we added to our longs on that one. But the sell signal.
Yeah.
What we're doing with sell signals right now is we're taking a small position, not larger than our bullish position, just a small position. But if SPX breaks support, we will completely flip into a bearish scenario. So right now, that sell signal was the modified McMillan Volatility Band sell signal. So let's say we bought 1 put spread on that for maybe every 6 or 7 bull spreads that were long based on the trend of SPX.
So you're staying with
And
the trend, but you're putting
right, so
on some select hedges almost against your trend
right,
strategy.
right. I mean, they're not going to both make money. That's
Right.
obvious. But I don't want to ignore the sell signals because that smacks of complacency. And
Yeah.
as soon as you start being complacent, you usually pay for it.
Yeah.
So so that's how we're treating it. So we're long, let's say 8. We're long 8 bull spreads in because we're bullish in the various things, and now because of that sell signal, and you'll see there's another one coming up here. We're long a couple of bearish spreads.
Okay.
So realized volatility. So realized volatility is how fast the market's been moving around in the past. Implied volatility is a forward look. So the 20-day historical
So
volatility is about
historical volatility is
right. So
okay.
it's the standard deviation, regular definition, standard deviation of daily percentage price changes, as I said, the Black-Scholes calculation of SPX. If that falls below 8%, that means the market has gotten pretty, tight and it's
Complacent.
about ready to explode.
Mm-hmm.
So what we've noticed is if it then rises above 10%, that's a sell signal. So we just got, is this the one we got on January 4th? I guess this is, maybe it also came on January 4th because there was a down day that day. I'm going to believe my own chart. In any case, we would enter this, and this one has a stop if the historical volatility falls back below 9%. So here's the chart. This is about a 2-year chart on S&P. And on the top is the historical volatility, 20-day historical. And on the bottom is your SPX index. So you can see that back here, this is 10%. The bottom, that's 10%. Scales over on the right there. So it fell below 8% and then rose back above. And that was a sell signal in 2019 in May. And it worked okay. I mean, it wasn't the best sell signal ever. It worked okay. You got another one in August. That was sort of a weird one. The whole decline happened in about 2 days, and then the market just went sideways for a while before it started going higher again. But then last year in late January, you got one. And you can see that implied volatility never came back below the 9. In fact, just kept going higher. And so this sell signal was in effect for the crash. Then we didn't get another one until September. And, September was a 9% correction. People don't quite remember that, but it was. But now we just got another one. So we got down here, we crept back above here. And so we just now have another one. We have
down there very long.
No, I don't put a criteria on that.
Okay.
But I have a longer term write up on this in our newsletters and things. In fact, I think we put out a free blog post on that not long ago, which you could probably find if you wander onto our website. Okay. But so with that kind of a track record, I'm not going to ignore this signal. So we bought another bear spread based on that. And if it falls back down here to 9%, then we would stop ourselves out for a loss. Now, I mentioned the 100-year chart. So here's the 100-year chart of realized volatility on the Dow Jones Industrials. 1928, so not quite 100 years. So the crash of 29 produced a monstrous rise. The scales on the right. 116% is what your historical volatility rose to. And you can see in 1987, here we got, again, a very similar high reading. And then this year, again, it got to 106%. So in these market crashes, this thing, historical volatility explodes. What was interesting, though, let's go back to the left. After the 1929 bottom, which actually occurred in November of 29, the market rallied for 6 months. And volatility, we don't know anything about implied volatility because options didn't trade back then. But we do know what historical volatility did, and it fell to here, 8%.
Okay, gotcha. Over on the bottom left of the chart.
Yeah,
it's a little hard to follow everything.
Oh, sorry. Yeah, right here.
Yep, got it. Okay. So
So
it
that
came
was
down to 8%,
that was
below
April of
8%.
1930. So
Okay.
we've essentially done the same thing. We've gone from 106% to 8%. We actually did it in September. We just did it again. I'm not saying, what happened then, of course, is the market collapsed back then. And then you got big highs in 31 and 32, then 39, the recession, then 1940 when it looked like England was going to lose the war. And then it never got back above 44% until for years until 1987. Now, since then, we've
decades
bumped up there a number of times. So the market's just been much more volatile since 1987 than it was prior. But in any case, to me, the fact that it could even do that in the worst bear market of all time, go to 8% before the bear market resumed. And of course, then you went to new lows. I don't really think we take out the lows of March 2020, but I do consider this an excellent sell signal when it comes from a high level and then falls below 8%. So that's what we have right now working as well. This just summarizes the various things we talked about. There's only two cells on that chart, the two green items, the McMillan Volatility Band sell signal and historical volatility. But all the others are either bullish or just overbought. So in general, we're still bullish, but we're adding bearish positions. I call it strategically, let's just say in small size. I want to finish up by taking a look at it. Well, first of all, I wanted to give you a bearish strategy I think is very usable right now, and it might be something you're not quite familiar with. But this is a spread, so it has, in this particular case, limited risk and largely unlimited profit potential. And it has a pretty low risk up through February expiration. So right now we've just, by expiration, I mean the third Friday. So last Friday was the third Friday of January. So let's say it's today. You buy two S&P or SPY March 330 puts, and you sell one March 360 put. And this costs about $1 right now, or 1 point, $100. So if you're wrong and the market goes up, the worst you can do is lose the $100 there. Now, the black line is what could happen at February expiration. So right here at the strike at 330, that would be a bad thing. But we're not going to stay that long. We're going to, that's March expiration. That's the black line is March expiration. At February expiration, which is this blue line, things can't really get all that bad because both options have a lot of time value premium. So yes, you can maybe lose $400, worst case scenario. But if it falls down in here below 318, you start to make some large money because you're long two puts and only short one. So this is a strategy that we're using in our newsletters, and we're putting it on in some of the managed accounts in some ways, different, a little bit more sophisticated way. But this is a pretty simple approach to have a big potential on a crash. 318 is not close to here, but we did go way past that last year. So, and what happens is, if the market continues higher, then you just lose a little bit, and you then set it up again at February expiration. So at February expiration, you sell this one off. It won't be worth much if the market went higher. And you set up a new one at that point in time. So this is a strategy that we are going to now continue to use in our newsletters and roll it out until the market breaks. So the last thing I want to talk about is a couple of seasonal trades that are apropos right now. And this first one is called the January Defect. I didn't invent that name. I think Steve Sugarrud did. But in any case, there's a consistent pattern of the NASDAQ market having a bearish period in the middle of the month of January. And defining what the middle of the month is a bit difficult, but it turns out with some probably optimization, maybe too much optimization, if you buy puts on the close of the 12th of trading day of January, which happened to be yesterday. And you hold those through the close of the 18th trading day, so 6 trading days. That's generally a winning trade. So we bought on the 20th. We're going to get out on the 28th. The track record over the last 20 years has been 16 wins and 10 losses. Now we're playing it with options, so our wins will hopefully be bigger than our losses. The median decline over that 6 trading day period is like 0.8% by NDX. So, and NDX is pretty high up there. So that's a 100-point decline or so in NDX. 2018, the reason I use median, because if you use averages, 2018 has too much influence. 2018, the market was roaring to the upside. I believe the whole market was up about 7 or 8% for the month of January. Of course, we paid for that with a big sell-off in February. That's less of a problem for option buyers because you can only lose what you put into the trade. And we're doing this in modest size. I'm not doing this crazy size. But anyway, that's the trade that we're in right now as of last night. And you can get into it today for relatively the same price. And I believe specifically we bought QQQ Feb 5th options because we're getting out of this trade on January 20th. So we bought the 324 puts and we sold the 309 puts. And then one more this is the last one. This is a trade that kicks in and goes long the market as the other one is ending on the 18th trading day of January. Larry Williams told me about this years ago, and we've been using it ever since. I've changed some of the parameters over the years, but the system as it stands now is we buy the market, S&P, at the close of the 18th trading day of January, and we exit 4 trading days later. This works best if SPX is up for the year, for the first 18 trading days of the year. So if it's not, we usually take a smaller position. And originally we used to hold for 5 days, but as it seems like everything happens in the stock market, as soon as the system gets to be well known, then traders front run it. So instead of waiting for the end of the 5th day to sell, people started selling on the 4th day. So we did too. This is the track record of that. In 2019, we were up 62.7 SPX points in that 4-day trade.
Wow.
On average, you're up, and this includes the losses, you're up 0.9%, and it's been a winner 27 out of the 35 years. So we have some better seasonal trades than that, but they occur in October and November, so we're past those, but I hope everyone will be a subscriber by that time. Speaking of that, so we are, as I said earlier, at this website, optionstrategist.com/cycles. If you go there, you can pick up the PDF of this presentation. And you can also get a 30% for a limited time, a 30% off on this. I write this newsletter personally every morning, and it's strictly speculation. It does all the trades that we've been talking about. Plus, it looks for takeovers based on heavy option volume. And we've been fairly successful in finding some of those. And our premier newsletter is called the Daily Strategist, which actually comes out twice a day. And then includes the weekly publication, the Option Strategist. And again, this really covers all facets of option trading, from volatility hedges to pure speculation, all the things we talked about here, but a lot more strategic stuff as well.
Excellent.
And we have a YouTube channel. I invite you to become a subscriber. We record a market comment every Monday morning. And we have 2 new newsletters. This one just got off the ground. It's completely different than anything we've done before, but it's basically contrary analysis to the fundamentals of a situation. So like if everybody hates a stock, the guy writing this for us is out of London. He's very good at this, and he'll be buying it for a longer term point of view, not just something that happened briefly. We started this a couple of months ago, and it's just on fire right now. And then a lot of people like to write puts, figuring that's a steady source of income. And of course, when you're writing puts, you make money about on 90 to 95% of your trades. You just hope the other 5% don't wipe out the 90 that you're making money on.
Like in March of 2020.
Yeah, that sort of thing. So we have an approach that's conservative and statistically based, but there's always risk in all of these things.
Absolutely.
So invite you to check that out. If you're interested in our money management, there is a money management website here at the bottom, and otherwise pay us a visit at optionstrategist.com/cycles.
Well, I would definitely pick up a copy of this PDF, everybody, and let me just pause here for one moment to just remind us all that we are the Foundation for the Study of Cycles, and we're celebrating our 80th anniversary. We are a not-for-profit 501c3, and we'd love you to, of course, subscribe to our YouTube channel, but also join us for a $99 annual membership. Prices are going to be going up soon, and make a donation if you can to support this incredible work that we've been able to bring you. People like Larry, Tom DeMark, Robert Prechter, and of course our own board members, Jake Bernstein, Bill Cerubi, Andy Pancioli, etc. So, Larry, that was a lot of information.
Yeah, I've been described as a fire hose.
Yeah, that's how I feel. I feel like I've been drinking from the fire hose for sure. But obviously stuff you've been working on for a long time. I'd just like to wrap up just kind of taking a step back, looking at the big picture, these kind of cycles of sentiment, right? These extremes of people, moving from one side of the boat to the other. And something that you showed that I thought was interesting, and, I kind of had this intuition, and I think a lot of people do, that the downside is a lot faster than the upside, or the inverse in your kind of put-call ratios, right? Like your put-call ratios go up really fast and they come down really slow, right?
Right.
Is that something you've seen pretty consistently across sentiment cycles?
Yeah. I mean, the as you saw in the chart, it went up very fast last March, and then it's taken a long time now to slide its way back down here. Yeah. And we weren't looking at 2018, but it was a similar situation there, just a shorter time frame. But in February of that year, if you recall, volatility exploded, put-call ratios went higher. It actually wiped out that inverse volatility ETF, the XIV. And then things turned bullish for a while, anyways, into like October, and it slowly came back down again. So I think if you get a really, really bad one again now, it might give some people some religion, but they really haven't gotten any so far. So why would that happen?
But I've talked to a lot of people, and a lot of smart people like you, right? I mean, and it seems like everybody's just sort of got, one eye on the exit, right? Like you've been through a number of market cycles, I'm guessing, over your career at this point. Have you ever seen this many smart people going,
ever?
With one foot out the door,
Yeah, and that's usually bullish for the market.
That's usually bullish, right?
Yeah, until finally they give up on it. But
right. And so you don't think that they've really given up yet, even the smart money. They're still hanging on, looking for the exits.
Yeah, and of course, what happens
the most bullish thing you could say about the market right now.
The exit becomes very narrow when everybody's doing that, because they're all waiting. They don't want to leave too early, but then when they all decide it's time to leave, that happens at once, which is really what happened last year. I believe it was February 24th, that Monday. We gapped down and just crushed. I mean, was the news on the coronavirus any worse that weekend than it had been like the previous weekend? I don't really think so. But what happened was, people were selling that week and not the previous weekend, so it just got crushed.
Yeah. Very good.
So, the danger of waiting is that, but the danger of acting too early is, probably worse.
Sell into strength.
Well, Good
little
idea.
bit, a little bit at a time. All right. We really appreciate it, Larry. Thank you so much.
All right,
Everybody,
thank
please
you.
visit Larry's website, optionstrategist.com/cycles, and get a copy of his presentation. And please visit us at cycles.org. And we'll be back tomorrow with Jack Schwager, author of the Market Wizards books. Really looking forward to me interviewing Jack. So Jack's usually interviewing everybody else, but tomorrow I get to interview Jack and talk about our experience this week and how to make sense of it all and what Jack has learned from talking to, literally the market wizards. So thanks everybody for attending. Thank you again, Larry. And
Thank you,
hope you
Richard.
can all join us tomorrow.
All right.
Good night.